Today, mortgage rate hikes are on the cards. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today we look at the latest from New Zealand, which we think is a likely leading indicator of what's ahead more widely. ANZ New Zealand just released a report called More Work for the OCR to Do. And they say, we've changed our OCR, official cash rate, call, adding in a 25 basis point hike in the April and July monetary policy reviews, in addition to the hikes we were already forecasting at the next 4 MPSs. This new track sees the OCR reaching 2% in August 2022. While we're upgrading our estimate of how much work the OCR needs to do, assuming all goes well, our view continues to be that the risk is high that something will happen to interrupt the hiking cycle before its completion. As a result, they warn that rising mortgage rates could make the housing market flip more abruptly than expected, from a support to a drag on household spending and construction activity. In a forecast update following release of the latest super hot inflation figures this week, ANZ economist Finn Robinson, chief economist Sharon Zona, and senior strategist David Croy note that the dramatic increase in the wholesale swap interest rate earlier in the week was so large there is real pressure for mortgage rates to rise further before long. This increases the chance that housing market momentum could turn more sharply than forecast and flip more abruptly than expected from a support to a drag on household spending and construction activity. And globally, they say, a reassessment of the likely average cost of borrowing over the next few years poses a challenge to asset valuations that underpin household wealth. And they also note that the longer COVID restrictions in Auckland drag on, the greater the risk of a hit to firms' investment and employment plans, though so far, they say, they've been remarkably robust. All up, it is far from a given that the wheels will stay on the bus while the Reserve Bank of New Zealand steadily increases the official cash rate for the best part of a year. And they say in the wake of the inflation figures, the ANZ economists have changed their OCR forecasts. They've added in 25 basis point hikes in the April and July monetary policy reviews, in addition to the hikes we were already forecasting at the next 4 monetary policy statements. This new track sees the OCR reaching 2% in August 2022. But the economists are continuing with their cautionary view that something could definitely go wrong in the meantime that would force the Reserve Bank to reevaluate the interest rate picture. It's important to highlight that although we are raising our central OCR forecast, we still think there is a significant risk that something happens to derail the hiking cycle before its completion, they say. Indeed, these risks are intensifying, if anything. The economists have also updated their inflation forecast. They say consumer prices rose 4.9% year over year in the year to September, stronger than their market-topping expectation of 4.5% and well ahead of the Reserve Bank of New Zealand August forecast of 4.1%. Inflation pressures are everywhere, they say, in the economy right now. Petrol prices are surging, supply chains are stretched, food prices have risen 6 months in a row, labour is in very short supply, and building costs are skyrocketing. Price increases are particularly notable in petrol, food and housing, essential items that will hit poorer households the hardest. Of most concern for the Reserve Bank is the fact that there is a very strong inflation impulse underlying all these pressures. Measures of core inflation are the strongest they've been since the 2000s, a period where the Reserve Bank of New Zealand was persistently behind the inflation curve. The Reserve Bank's preferred measure, the sectorial factor model, is the lowest, but at 2.7% and upwardly sloping, one can reasonably question how long that's likely to remain inside the Reserve Bank of New Zealand's 1 to 3% target band without action. And the 30% trimmed mean jumped from 3% to 4%, indicating just how broad-based inflation pressures are currently. So let's say as a result of these supply chain pressures and energy costs, we are forecasting inflation to reach 5.5% year over year in the fourth quarter of this year and to peak at 5.8% in the first quarter of 2022, with a helping hand from the annual increase in tobacco excise tax, which we indexed to Q3's 4.9% big inflation print. It's impossible to know exactly how much of these supply chain disruptions will flow through into imported inflation. The peak inflation could be above or below what we've picked, they say. The fact that a lot of inflation pressure currently is driven by supply-side factors doesn't mean that rising interest rates won't work to head it off. That raising interest rates won't work to head it off by reducing appetite to borrow and making indebted households more price sensitive. Rate rises will throw sand into the gears of the inflation process by impeding the pass-through of costs. Lower demand means less inflation pressure than otherwise, regardless of the mix of demand and supply developments that kick it off. And the ANZ economists note that short-end wholesale interest rates aren't far off pricing in their new forecast, with an OCR of around 1.92% priced in by August, by which time we expect it to have reached 2%. Given the intensity of medium-term inflation pressures, we are now forecasting that the Reserve Bank of New Zealand will take every opportunity it gets over the next while to raise the official cash rate. In short, the very strong inflation pulse has taken away the luxury of time and caution, as the OCR has more work to do. We estimate the OCR will need to go to around 0.5% above neutral, which we estimate to be at around 1.5% currently, and the Reserve Bank of New Zealand estimates neutral to be 2%. So we expect the November MPS will show the OCR rising steadily to around 2.5% or a little higher. And the economists note that supply chain disruption has been a key driver of prices over the past year, and as the Christmas rush builds, these pressures are likely to get worse over the next few months. More concerning for the Reserve Bank is the steep rise in the measure of core inflation. It's still highly uncertain how high and when exactly inflation will peak, but it's very clear that more needs to be done to get ahead of the inflation curve. And they say we continue to expect that inflation pressures will moderate in time. Supply chains should eventually adjust to the post-COVID norm. And in fact, we're forecasting tradable inflation to dip into negative territory as price levels normalise. As the Reserve Bank of New Zealand removes monetary stimulus from the economy, domestic inflation pressures should also ease. And now, while we're over in New Zealand, it's worth considering what's happening to home prices there based on data which was released by the REINZ last week. In fact, New Zealand home prices fell in September. There was a substantial decline in the national median house price in September, with the Auckland market leading the decline. According to the Real Estate Institute of New Zealand, the national median selling price declined by $55,000 from $850,000 in August to $795,000 in September. That's down 6.5%. The biggest decline was in Auckland, where the median price dropped by $50,000 from $1.2 million in August to $1.15 million in September. That's down 4.2%. However, outside of Auckland, most regions continue to post increases in their median selling prices, with the median in all regions except Auckland increasing by $20,000 from $700,000 in August to $720,000 in September. That's up 2.9%. Apart from Auckland, the regions where the median price declined in September compared to August were Waikato, down $5,500, Taranaki down $30,000, Wellington down $15,000, and the West Coast down $13,000. The median price was unchanged in Northland, and all other regions posted median price rises in September. The overall market was obviously affected by lockdown restrictions, with 5,385 residential sales recorded nationally. That's down 37.9% compared to September last year. Jen Baird, Chief Executive of REINZ, said September was always going to be a month to watch as we assess the impact various COVID-19 alert levels have had on the New Zealand property market. What the data shows is that confidence remains high, buyer demand is still strong, and outside of Auckland, buyers will be pleased to see more property coming onto the market. Prices are proving resilient, she said, with some regions noting a decrease in the number of first home buyers, in part due to rising prices. Median house prices across New Zealand increased by 15.4% to $795,000 in September 2021, compared to $689,000 in September 2020. However, that was down 6.5% in August. New Zealand, excluding Auckland, showed year-on-year growth of 23.1%, an increase of 2.9% in August 2021, suggesting that as alert levels ease, the market is beginning to see a lift. Looking at Auckland in particular, while the median house price is down slightly on its August record of $1.2 million, all districts increased year over year, with the Papakura district reaching a new median high. Auckland spent the first 3 weeks of September in alert level 4 lockdown, which meant no real estate activity could take place. What we've seen in other parts of the country is that activity picks up as restrictions ease, and we expect the same in Auckland. The REINZ House Price Index reached a new national high of 4,088, showing that the underlying value of property remains strong. Growth was distributed across all regions, with 11 of the 12 regions reaching a record level in September. Wanganui saw year-on-year growth of 45.8%, the Bay of Plenty was up 37.2%, and Gisborne Hawke's Bay was up 36.8%, and Wellington up 34.9%, showing particularly strong annual sales growth increases, Baird noted. Various levels of lockdowns across New Zealand have influenced activity in the real estate market this month, leading to mixed results. But she said we expect to see a rise in activity as restrictions ease further, especially in Auckland. Demand suppression measures introduced this year, recent moves by the Reserve Bank to increase the OCR and COVID-19 restrictions to real estate activity are creating headwinds for house prices, and we can see that the pace of price rises have slowed over recent months. The number of residential property sales across New Zealand decreased by 37.9%, from 8,673 in September 2020 to 5,385 in September 21. That's the fewest properties sold in a September month since 2011. September's sales are a result of varying lockdown alert levels across the country that have curtailed real estate activity as we all take action to prevent the spread of COVID-19. For New Zealand, excluding Auckland, the number of properties sold in September 21 decreased 28.7% year over year to 4,047, but sales increased 13.8% compared to August 2021 at 3,557. New Zealand, excluding Auckland, returned to alert level 3 at the beginning of September, and during the week 1 September to the 7th of September, the number of sales was 677 compared to 577 the last week of August under alert level 4. In the following weeks, as the country excluding Auckland moved to alert level 2, a steady increase was maintained, reaching 854 in the week 8th of September to the 14th of September, 918 in the week 15th of September to 21st September, and 1,035 in the week 22nd of September to the 28th of September. In Auckland, the number of properties sold in September decreased by 55.3% year over year, from 2,996 to 1,338. That is a significant decrease, illustrating the impact of the prolonged lockdown in the region. And while the profession was able to complete sales virtually, the continuation of alert level 4 into September saw a further drop in activity in Auckland. In the first 3 weeks under alert level 4, the number of sales was 299, 1st to 7th of September, 255, 8th to the 14th of September, and 239, 15th of September to the 21st of September, before seeing an uplift with the move to alert level 3 in the week 22nd to the 28th of September, where 344 sales were recorded. As restrictions ease in the region, it's expected sales will continue to rise. So when you juxtapose those two commentaries, that official cash rates are likely to rise and mortgage rates are likely to rise, and that sales could increase as COVID restrictions are removed, it seems to me that we have a short-term and a long-term problem. The short-term problem is it's uncertain how quickly restrictions will be easing, but long-term mortgage rates are on their way up. And because of the massive leverage that households have in New Zealand, as they do, of course, in Australia too, even small increases in the cash rate will have a profound impact on demand for mortgages and the affordability of those mortgages already provided. It seems to me that we are at a turning point, and in fact New Zealand is leading the way and giving us a sense of how things may play out ahead. It now becomes a question of how quickly central banks around the world react to the new environment. And by the way, somebody asked me the other day, am I still in the deflationary camp or the inflationary camp? Well, my own view is that there is definitely short-term inflation in the system, but actually as credit is withdrawn, thanks to higher interest rates and tighter lending standards, the deflationary impacts that are lurking there below the surface are likely to re-emerge. So I am still sitting towards deflation as being the longer term outcome, which is not good news, by the way, but it does mean that essentially those with massive amounts of debt could be sitting on assets whose appreciating value will turn, and if it does turn, it could turn quite quickly, because as the ANZ says, interest rates could be rising quite quickly too. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.